Italy's Veneto banking scandal, when community banks became criminal enterprises. In the rolling hills of Italy's prosperous Veneto region, where medieval towers pierce morning mists and industrial wealth flows like fine wine, two community banks that had served local families for over a century collapsed in spectacular fashion during the summer of 2017. Banca Popolare di Vicenza and Veneto Banca didn't simply fail due to market forces or economic downturns. They were systematically looted from within through a web of self-dealing loans, regulatory capture, and outright fraud that would ultimately cost Italian taxpayers 17 billion euros and destroy the life savings of thousands of retail investors. This wasn't just another banking crisis. This was organized financial crime dressed up in the respectable clothing of cooperative banking, where executives treated depositor funds as their personal piggy bank, while regulators looked the other way. The Veneto banking scandal represents one of Europe's most egregious examples of how trusted financial institutions can be transformed into criminal enterprises, leaving entire communities financially devastated while enriching a small circle of well-connected insiders. The roots of the Veneto banking disaster stretch back to Italy's unique cooperative banking model, where local Banche Popolari were originally designed to serve their communities rather than maximize shareholder profits. Banca Popolare di Vicenza was founded in 1866 as a mutual credit society, intended to provide banking services to small businesses and families in the Veneto region. For over a century, it operated as intended, becoming deeply embedded in the local economy and culture. However, beginning in the early 2000s, the bank's leadership began pursuing an aggressive expansion strategy that would prove catastrophic. Under the direction of Chairman Gianni Zonin, who controlled the institution for over 2 decades, BPVI embarked on a reckless lending spree that prioritized personal enrichment over prudent banking practices. Zonin, a local businessman with extensive real estate holdings, used his position to orchestrate what prosecutors would later describe as a systematic looting operation. The bank's transformation from community lender to criminal enterprise accelerated after 2010, when regulatory changes allowed cooperative banks to expand beyond their traditional geographic boundaries and increase their risk appetite substantially. The mechanics of the fraud centered around an elaborate scheme of self-dealing loans that violated every principle of sound banking. Gianni Zonin and his associates created a complex web of shell companies, real estate ventures, and investment vehicles that existed primarily to receive loans from BPVI on favorable terms with minimal collateral or oversight. Between 2010 and 2016, the bank extended over 2 billion euros in loans to companies controlled by Zonin and his family members, often without proper documentation or realistic repayment schedules. These loans were used to finance everything from luxury real estate developments to speculative business ventures that had little prospect of success. In one particularly egregious example, BPVI provided 200 million euros to fund Zonin's acquisition of a Venetian palace that was then used as collateral for additional loans from the same bank. The circular nature of these transactions meant that the bank was essentially lending money to itself while booking the transactions as legitimate commercial lending. Internal bank documents later revealed that senior executives knew many of these loans would never be repaid, but continued approving them because they generated substantial fees and bonuses for the management team. The regulatory environment in Italy during this period created perfect conditions for the Veneto banking fraud to flourish unchecked. The Bank of Italy, which served as the primary regulator for cooperative banks, maintained an inspection regime that was both understaffed and compromised by conflicts of interest. Many Bank of Italy officials responsible for supervising BPVI had personal or professional relationships with the bank's leadership, creating a culture where serious violations were routinely overlooked or minimized. When inspectors did identify problems, their reports were often buried or ignored by senior regulators who prioritized maintaining stability in the banking sector over enforcing compliance. The European Central Bank assumed supervisory responsibility for significant Italian banks in 2014 as part of the Banking Union initiative. But BPVI initially fell below the asset threshold for direct ECB oversight. This regulatory gap allowed the fraud to continue undetected for several additional years, during which time the losses multiplied exponentially. Perhaps most damaging was the Bank of Italy's decision to allow BPVI to continue operating and even expand its retail investment business, while knowing that the bank was technically insolvent, a decision that would ultimately expose thousands of additional retail investors to catastrophic losses. The human cost of the Veneto banking scandal became tragically apparent as the full scope of the fraud was revealed. Over 40,000 retail investors, many of them elderly retirees who had trusted their local bank with their life savings, lost everything when BPVI collapsed. These investors had purchased subordinated bonds issued by the bank, often without understanding the risks involved or receiving proper disclosure about the institution's deteriorating financial condition. Bank employees routinely sold these high-risk instruments to customers as safe alternatives to traditional savings accounts, earning substantial commissions while knowing that the underlying bank was insolvent. Luigi Lazzaro, a 68-year-old pensioner from Vicenza, lost his entire retirement savings of 100,000 euros after being convinced by his longtime relationship manager to purchase BPVI bonds just months before the collapse. His story was repeated thousands of times across the Veneto region, as families discovered that their trusted community bank had systematically betrayed their confidence. The psychological trauma was as devastating as the financial losses, with several investors committing suicide after learning they had lost everything. Local newspapers documented a wave of depression and anxiety among affected families, many of whom had never invested in anything riskier than government bonds before being persuaded to purchase bank securities they didn't understand. The collapse began to accelerate in late 2016 when the European Central Bank finally assumed direct supervisory authority over BPVI and immediately identified massive irregularities in the loan portfolio. ECB inspectors, unencumbered by the conflicts of interest that had compromised Italian regulators, quickly determined that the bank was hiding billions of euros in bad loans through creative accounting and off-balance sheet vehicles. In December 2016, the ECB ordered BPVI to raise additional capital or face resolution procedures, setting off a desperate scramble by bank management to find new investors. However, the due diligence process revealed the true extent of the fraud, making it impossible to attract legitimate capital. Internal emails obtained by prosecutors showed that senior executives spent the final months destroying documents and transferring assets to personal accounts rather than attempting to save the institution. By early 2017, it became clear that both BPVI and Veneto Banca, which had similar problems, were beyond salvation. The European Single Resolution Mechanism declared both banks failing and removed their banking licenses on June 25, 2017, marking the end of institutions that had collectively operated for over 250 years. The aftermath of the collapse revealed the full extent of regulatory capture and criminal behavior that had enabled the fraud. Italian prosecutors launched criminal investigations that resulted in over 100 indictments, including charges against Gianni Zonin for fraud, embezzlement, and criminal association. Court documents revealed that Zonin had extracted over 150 million euros from BPVI through various schemes, using the money to fund a lavish lifestyle that included multiple luxury properties, a private jet, and extensive art collections. Bank executives had routinely falsified financial reports to hide the extent of bad loans, creating fictional repayment schedules and using derivative instruments to shift losses off the balance sheet. The investigation also uncovered evidence of systematic bribery involving Bank of Italy officials, with BPVI executives providing gifts, travel, and employment opportunities to family members of key regulators. Perhaps most shocking was the discovery that the bank had continued aggressively marketing retail investments even after senior management knew the institution was insolvent, a decision that prosecutors characterized as deliberate fraud against retail customers. The Italian government's response to the Veneto crisis highlighted the broader political and economic implications of the banking scandal. Prime Minister Paolo Gentiloni's administration was forced to provide 17 billion euros in public support to facilitate the liquidation of both banks and protect depositors, making it one of the most expensive bank failures in European history. The rescue package required approval from European Union competition authorities, who demanded that shareholders and bondholders bear the full cost of the failure rather than taxpayers. This burden-sharing requirement meant that retail investors who had purchased bank bonds lost everything, creating a political crisis as thousands of middle-class families faced financial ruin. The government established a voluntary compensation fund that eventually provided partial restitution to some retail investors, but the amounts were insufficient to restore their losses fully. The crisis also exposed fundamental flaws in Italy's cooperative banking model, leading to regulatory reforms that forced many Banca Popolari to convert to joint stock companies with more robust governance structures. However, critics argued that these reforms came too late to prevent similar scandals at other cooperative banks across Italy. The Veneto banking scandal serves as a masterclass in how regulatory capture and institutional corruption can enable massive financial fraud to flourish undetected for years. The combination of a permissive regulatory environment, conflicted oversight, and a business model that prioritized growth over prudence created perfect conditions for criminal behavior. The scandal also demonstrated how supposedly conservative cooperative banks could be just as dangerous as aggressive investment banks when proper controls are absent. The victims weren't sophisticated institutional investors who understood the risks they were taking, but ordinary families who trusted their community bank and received criminally negligent advice from people they considered friends and neighbors. The scale of the fraud, totaling over 8 billion euros in direct losses plus government support costs, ranks among the largest banking scandals in European history. Yet perhaps most troubling is how preventable the entire disaster was, given that multiple red flags existed for years before regulators took action. The Veneto case proves that banking supervision requires not just technical expertise, but also institutional independence and the political will to hold powerful institutions accountable, regardless of their community connections or political influence. The legacy of Italy's Veneto banking scandal continues to reverberate through the country's financial system and serves as a cautionary tale about the dangers of regulatory capture in the banking sector. As of 2024, criminal trials related to the scandal are still ongoing, with prosecutors seeking prison sentences for dozens of bank executives and regulatory officials who enabled the fraud. The collapse of BPVI and Veneto Banca marked the end of an era for cooperative banking in Italy and accelerated broader reforms across the European banking sector. The scandal also contributed to growing public distrust of financial institutions and regulatory authorities, with polling showing that confidence in Italian banks remains significantly below pre-crisis levels. For the thousands of families who lost their savings, the Veneto banking scandal represents not just a financial disaster, but a profound betrayal of trust that has forever changed their relationship with the banking system. Their story stands as a permanent reminder that behind every banking scandal are real people whose lives are destroyed by the greed and criminality of those entrusted with their financial security. In the end, the Veneto banking scandal proves that no institution, regardless of its community roots or charitable mission, is immune from corruption when proper oversight and accountability mechanisms are absent.